Hey everybody, happy Monday. Happy Monday, happy Monday. A lot different in the market right now than it was a couple hours ago, over the weekend, over last night. How is everyone doing? And can everyone hear me okay? Kay is in the house. I love it. How are you, Kay? All right. So yes, this is what happens with geopolitical events. Let's just cut right to the chase here. Okay. This is what happens. Okay. Anybody know who this is? I actually, if you read my week ahead, I actually started my week ahead market update with this guy in there. The opening words to this song is "War, what is it good for?" And then it's absolutely nothing. Say it again. Somebody responded back to me. It was very good. Somebody emailed me back and said, just the Undertaker, which is part of the song as well. But, you know, there was a lot of anticipation going into the weekend, like there has been for the last few weeks, that maybe we are going to, go to war. Okay. And nobody wants that. We don't want it. I don't want it. You don't want it. The market doesn't want it. Unfortunately, um, it's kind of the world that we live in, the world of geopolitics, and there's always geopolitical risk out there. And I think that in this day and age, we always have to be set for or ready for something to pop up. And so far, the market is relatively calm, right? But the risks with this clash could be much bigger. They definitely could become much bigger. We hope it doesn't. All right. So the markets, investors, traders, I guess maybe it's a good thing. I'm not sure. We kind of have become used to brushing off, ignoring geopolitical tensions in recent years. This one, is it going to last a couple days, couple weeks, longer than that? If it lasts longer than that, the market ain't going to like it. Okay. And I don't mean to be callous in any way, shape, or form, just to talk about what is going on in the terms of finance or the markets, because obviously it goes much deeper than that. Loss of human life, all of that. We're not talking about any of that. We're really talking about how this, you know, engages into the marketplace. Okay. The longer this goes on, the worse it's going to be for the market. Okay. If you were reading again over the weekend, just as we've talked, it seems like we've talked about this on Mondays, reading things over the weekend on FinTwit or, whatever it might be. Um, if you were reading the doom and gloom scenarios over the weekend about the markets, that this is going to be the biggest sell off in the history of the markets, it's going to be the crash, it's going to be, you better have had your puts in place, blah, 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 blah. Right? We don't know. We just don't know what the reactions are going to be. Obviously, the market doesn't like the turmoil. The market doesn't like the uncertainty. The immediate reaction certainly was predictable. We saw a big surge in oil and gas prices. Those have come off their highs. We saw a big surge in gold and other safe haven assets. Those have come well off their highs. Beneficiaries like defense stocks, okay, those have come off their highs. Airline stocks, which typically get hit, yes, they did. They've started to come back a little bit. Okay. So it is so incredibly important, which is why we haven't been, quite frankly, that busy today. not to overreact. We cannot overreact. Okay. It's so important. Now, there were a few things we tried to do this morning to take advantage of what I considered the extreme pop and volatility. Also, things where, from a technical and or fundamental standpoint, things made sense. But just to overreact, that's where you get in trouble. If I had $1 for every one of these gurus and pundits over the weekend on Twitter or at X, I could probably bring them up right now, and that said, "This is it. This is it. This is the one I've been waiting for. You better follow me." Blah 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 blah. Right? Um, I'd be a wealthy man if I had $1 for every one of those that I saw, and probably that you guys all saw as well. Okay. We cannot overreact. Trying to trade on unpredictable geopolitical events is usually not the smartest thing to do. We typically can see moves gyrate back and forth, reverse quickly. Okay. So, can everybody see this? I know it's a little bit difficult to see here. Maybe you can all kind of hone in on the screen here a little bit. I also did put this in my week ahead as well. Okay, this is really interesting. This is really interesting. These are dating back to World War II, basically. How the market has reacted to major geopolitical events. I'm not going to go through every single one of these line by line by line. Okay. But you can see that for the most part, for the most part, with the exception of 1973, okay, which was not only the Yom Kippur Day War in Israel, but the oil embargo, because that's something that lasted a long time. It affected every aspect of the economy. So, with the exception of that, and with the exception of really the great financial crisis in 08, 09, when Lehman Brothers and Bear Stearns collapsed, look at the rest of the chart here. Look at the rest of the chart. Now, I am not suggesting, boy, we get into a mess, we get into a war, we get into a geopolitical event that you should go out and buy. Okay. But what I am suggesting is, just like after most other volatile events, whether it's geopolitical, whether it's earnings, whether it's the Fed, whatever it is, things typically normalize. Things typically normalize. And if you go back to the last 25 years, with the exception of the great financial crisis, look at the results. Look at the results. And again, we're traders, we're not investors, so maybe this is, more apropos to your 401ks, your IRAs, investing, not as much trading. But boy, oh boy, this is really some data here. And yeah, past performance does not guarantee future results. We all know that. No question about it. No question about it. Okay. Now, how was I preparing for today? And how should all of you been preparing for today? You got to know what your positions are. You should know that on a daily basis, but especially coming off of a long weekend, all this news, right? You got to come in the morning knowing what your positions are. Where do you maybe have some risk? Where can you benefit from the market? Okay. Just because you may have had short positions doesn't mean you should hold on to them. Just because you had long positions doesn't mean you liquidate them. But a situation like we are experiencing right now, and which seems to happen, I don't know, it's monthly, quarterly, and again, whether it's a geopolitical event or something else, really amplifies what I always say. We always discuss what? Besides go to the short strike, what do we always discuss for your trading accounts, for your portfolios? Buy when you can, not when you have to. Buy your insurance when it is on sale, not when the house is burning. Does everybody understand what that means? Manage your risk. That's right, Hilda. Manage your risk. Okay. But this little one right here, she doesn't know what's going on. She's just happy. She is just happy. So let's get that word up there. And then we're going to look at some markets here and see what that deep skew that we've been watching for the last week and a half or so. We're going to look at that deep skew and see now that some news is out, right? You know that old adage of like buy the rumor, sell the news sort of thing? Well, now that this has started, and I know there's all sorts of deep political divide. We should, we shouldn't. How can you say it's a war? It's not a war. We're not talking about any of that. Okay. But now that this invasion war event has happened, let's see how the market is reacting. Okay, from that skew perspective, everybody understands what I'm talking about. That skew perspective. All right, let's take a look. Let's look at SPY, which is now up. S&Ps are up 10 points right now. And let's go to the end of the week. And 687-ish is where we are trading. Let's turn that to yellow. Can everybody see the charts here? I know it's hard to read. Okay, 687. Okay, let's go. Let's look, I don't know, 1% out. Okay, like we've been doing. So 1% out roughly. Let's just call it $60 out. Or I'm looking at SPY, not SPX. So let's call 7 points out. So let's go down to the 680s on the put side, and let's go up to the 694 on the upside. Okay, there's still a pretty significant skew here. It's not as bad as it was a week or two ago. But look at what the downside implied vol is compared to the upside implied vol. So the market is definitely still pricing in where people want to buy that downside protection. Does everybody see that? Does everybody see that? Okay. Now, let's take a look at NVIDIA. Earnings are behind us. That news is out. NVIDIA is actually up $5 today, $6, which by the way happens to be fantastic for our iron condor that we sold at $2.50 on Friday, now trading $1.95. But let's look at what kind of skew there might be. So we're trading 182 and a half. Oh, good. This make it easy. We're trading 182 and a half. Let's go 5% would be $9. Is that? Yeah, we'll just go $10 either way. So just over 5%. Okay. So even in Nvidia, we are seeing a bit of a skew. Okay. So if you are savvy enough, if you understand the concept of these risk reversals, if you were listening in last week, there's definitely something to take advantage of there. There's definitely something to take advantage of there. I'm assuming since that skew is still pretty big in the SPY, though not as big as it was. I'm assuming it'll be very similar in the Qs. So we are at 609 in the Qs right here. So let's look at you know 3% move would put us down to about 589, 590 area. And wow, there's a much bigger skew. There is a much bigger skew in the Qs than there is in the SPY. How do I know that? Well, if we look at the downside, okay, 20 points out of the money, those puts are trading $1.85. Does everybody see that? Does everybody see that? Okay. Where is the commensurate? Where is the commensurate $1.85 on the call side? Yeah. Yeah. It's at the 618-ish. Okay. So we're looking, let's say $9 on the upside and basically $19 on the downside. Massive, massive skew. Massive, massive skew. Does everybody understand that? So before we go to the wheel here, let's say you wanted to do a risk reversal in the Qs here. Okay. And this happens to be this Friday's expiration. This is what I chose. Theta and Theo. No, that's hang on. It's Theo in both. Just had it covered. It's Theo in both. Okay. So if you wanted to do a risk reversal, everybody, what would you do? I know as a trader on the floor, when this opportunity was presented, I know exactly what I would do. Okay. The delta of these puts are about negative 18. Okay. The delta of the same out of the money, and I'm looking for these $18 out of the money. The delta of those calls are only 6 or 7. Okay. So if I were to do a risk reversal, here's what I would do. I'd be selling these puts, okay, that are $20 out of the money. I would be buying calls, not that are $20 out of the money. I'd probably move the strike up a little bit, maybe to like the 620 strike. Okay. So I would be paying $1.20 for those calls. I'd be selling these puts at about $2. So I would get an 80-cent credit. Okay. And what would the delta be? What would the delta be if I wanted to put on a delta neutral trade by buying those calls and selling those puts? If you bought one call, sold one put, what would that delta be? Okay. Trading Den, you're saying 1. Well, Kent, the delta on the calls are about 18 as well. And the delta on the puts are 18. So what would the delta on that risk reversal be? If you bought them both, Zahor, they're delta even, but we're not buying them both. A risk reversal in this case would be buying the call, selling the put. Trading Den, they're not 1 + 1. Kent, it's not 1. Come on, guys. If I bought an 18 delta call, sell an 18 delta put, what is it's not neutral. It is definitely not neutral. It is not 0. There we go. It is 36. Does everybody understand why that would be a 36 delta position if I bought a call and sold a put? I would have a net positive 36 delta. So if I then wanted to have a delta neutral position, okay, and I wanted to hedge it with the Qs, I would have to sell 36 Qs. Now, we're going to work in lots of 100. Okay. So let's say I did 10 of these. So let's say I bought 10 calls. I sold 10 puts. That would give me plus 360 deltas. I would sell 400 Qs. At that point, I would be almost delta neutral. Now, I will go into this tomorrow, but as a trader doing this for 35 years and trading literally tens of thousands of these, okay, when there's that much of a skew, I would want to overcompensate the position towards the skew. What does that mean? Well, right here, I'm delta neutral, right? If I did it 10 times, I'm just short 40 deltas. I have 360 long deltas between my calls and puts. I have 400 short deltas in my Qs. Because there's such a massive skew to the downside, I would probably sell a little bit more in the Qs. I would probably sell 500 Qs and what's called lean that position to the downside a little bit to give me a little bit more leeway in case the market does go the way of where the skew is. Does that make sense to everyone? So delta neutral would be 360 Qs. As a trader and having done this for 30 plus years, literally, like I said, tens of thousands of times, I would sell a little bit extra Qs. Tomorrow we can go through that and I'll actually go through a P&L analysis showing what the reward and risk would be. Okay? Does everybody understand that? And now, one last thing before we go to the wheel. Sorry, everybody. If I bought 10, 6, 20 calls and I sold 10, 590 puts, and I sold 400 Qs at 608. Okay. At expiration, which again, I just randomly chose this Friday, March 6th. Where would I want the Qs to be? Where would I make the most money? And by the way, I did this for an 80-cent credit. Where would, well, delta neutral beach bum is never going to lock in your profits. It's going to allow you not to have massive swings, not to have a one-sided trade. But if I had this position on, where on March 6th expiration would be the best place for the Qs to be? Okay. Above 590, 620 plus, 620, 608.01, 590, between 620 and 590. I love that we have lots of different answers. And I'm going to leave you with this, and then we'll actually go through the P&L tomorrow. Okay. I have collected on the option position 80 cents. Okay. So think of it this way. Where, trading den. See, same thing. It's a different position, same answer. Short strike wins. So where will this position of being long 10 of those calls, selling 10 of those puts, where will this position be worth the most while at the same time, I'm short stock, or in this case, short the Qs, right? Because if the Qs were to go up, that's going to be bad for my Qs position. So where do those two coincide? Okay, nicely done. Well, 608 wouldn't be a bad place, AJ. 608 would mean that I just keep the credit on the options and I have a wash on the Qs. So that would be okay. That would not be ideal. That would not be the best place. Where can I still keep all this credit while I'm making money here? Or I should say, where can I make the most money on the Qs at the same time as I'm keeping all the credit on the options? Not 605. Wouldn't I make more money in the Qs if it went to 600 or 595 or 590 even? Right? Qs could go down to 590 and I am still going to keep all this credit, right? Because the option position will be worth zero. Not 590 to 620, Zohor. 620 would be a really bad spot. In fact, 620 would be the worst spot on the board. At 590, the option position is still worth zero. So I get to keep my entire 80-cent credit. While at the same time, my short quantity of Qs has maxed out while I get to keep all this credit. The two lines intersect at 590, where my Q position makes the most while I make the most on my option position. Does everybody understand that? Always the short strike. Always the short strike. Does everybody understand that? Okay, we will go into this more tomorrow. I know we really got in the weeds on this, but guys, ever since last week when we started talking about this big skew in the market, right? Puts out of the money puts in the SPY, S&Ps, Qs being so much more expensive than the out of the money calls. We've got to understand what we can do there. Okay, let's get the wheel up here. Oh, Mike Clark. Now, you guys got to know I did not ask Mike Clark to do this. I had no idea what it was until I just opened up the wheel. Yes. Yes. It is almost baseball season, folks. All right, let's give it a whirl here. Love this, Mike Clark. You're my hero. Today's wheel winner is Snow X or Sparky Texas Longhorn. Trading Den, you're very welcome. Thank you. Sparky Texas Longhorns, are you in the house? Sparky is in the house. Way to go. All right. As we have up on the screen there, shoot me an email. We will get you out some swag. My apologies to anybody that is a White Sox fan. Not that I dislike the White Sox, but I am, as you know, through and through a Cubs fan. So that is great stuff. All right, everyone. Thank you. Thank you. Thank you. I think we hit record numbers today. I think we hit record numbers for viewers today. Tomorrow I will be on the trading floor. I will be down on the CBOE trading floor in the S&P 500 pit. So hopefully it's as busy there today or tomorrow as it was today, and you guys will see a lot of action going on. All right, everybody. Thanks again. Appreciate all of you, and we'll see you tomorrow.